Let us understand the difference between debt and equity. Every business, in order to run its show, it needs funds. These funds can come from owners, it can come from outsiders. When it comes from owners, we call it as equity. When it comes from outsiders, we call it as liability. We can classify the funds coming from owners as direct contribution and indirect contribution. Direct contribution means money coming from the pockets of the owner. We call it as capital. Indirect contribution means these are all the profits earned by the entity. They are actually payable to the owners but not paid but retained within the entity. We call them as reserves and surplus. So owners can contribute in these two forms. I mentioned money coming from outsiders are called as liabilities. These liabilities can be classified on the basis of time. We can have short-term liabilities and long-term liabilities. Short-term liabilities are those liabilities which have to be repaid within a period of 1 year, and long-term are basically repayable after 1 year. Technically, we call short-term liabilities as current liabilities, so long-term liabilities will be called as non-current liabilities. Now let us understand the difference between these two, debt and equity. Equity is basically a permanent fund because this is coming from the owners. They come in the name of capital and there will be no repayment schedule attached to it. It means if at all these funds have to be repaid, it can happen only through buyback arrangement or it can happen at the time of liquidation of the entity. Whereas debt is basically a temporary fund. It comes with a repayment schedule. It may be repayable on demand or they can be repayable as per agreed structured repayment schedules. Number 2. Equity is considered as less risky for the business because there is no compulsion to pay interest or return. Only when business makes profit, they are going to pay that. So in that angle, it is less risky. But debt is considered as more risky for business because it is going to attract financial risk. So whether a business makes profit or suffers loss, the cost of the debt have to be met. So in that angle, it is more risky. Now let us look at it from the investor's point of view. For equity shareholders, investment in equity is more risky because they have to bear all the risk of not getting return, the risk of capital getting wiped off, all this. So for them, it is more risky. And for lenders, debt is actually less risky because lenders will safeguard themselves with a fixed repayments, that is fixed repayment of the interest and principal. They'll have primary security, collateral security, personal guarantee, all those. So it is less risky for them. And if you look at the cost of equity, it is generally considered as very high because of all the risk attached to it, and debt cost is comparatively lesser because it is less risky. And if you look at it from tax angle, equity does not give any tax benefit to the business entity because whatever the dividends they are going to pay, that cannot be claimed as an expense. But debt is having tax benefit. Whatever the interest they are going to pay, that will be considered as expense, that will reduce the profit and that will reduce the taxes as well. Bringing more equity into the business from new shareholders, new owners will actually result in dilution of the control. That is, existing owners' control will get reduced whenever new owners are coming in. But that is not the case with debt. Debt will not lead to any dilution in ownership control. And this is something already I have highlighted. For equity shareholders, for owners, return is payable only when business makes profit. So it is linked with the profit. If there is no profit, business can take a stand. The management can take a stand that they can't pay any returns. But that cannot be the case with debt. The return, that is interest on debt, have to be paid because it is fixed and agreed. It has to be paid, let whatever be the scenario in the outside world. When it comes to repayment, owners are the last to get repaid when the business undergoes liquidation. So they are last in the queue. Whereas whoever have given debt where the charge is created and secured, they will have high priority. And if you look at the forms, equity will be in the forms like capital and reserves and surplus. And debt can be in the forms like loans, debentures, bonds, and so on.
You may have heard about our Credit and Financial Analysis Mastery course. It's a comprehensive course with 70 plus hours of video lectures, 15 plus ebooks, and various supplementary reading materials designed for banking and finance professionals to master SME and corporate credit. If you haven't gone through the course, if you want to feel the course, you can explore our demo course. Just comment demo. I'll send you the demo course invite link. You can go through that and then take a decision on enrolling the comprehensive course.